Hi everyone. We're going to give everybody just a couple minutes at the top of the hour. We'll get started. So just sit tight and we will let you know when we begin in 3 minutes. All right, everyone, we are at the top of the hour, so for the sake of time, I would like to get started now. Thank you all for joining so much. This webinar will be recorded for future use if needed. We ask individuals to utilize either the question or the chat feature that you can see. I think most of the time we're going to save questions towards the end, but I will be monitoring with Jennifer, to address questions if they are relevant to the current slide. My name is Lauren Hensley. I work here at Kaplan in the College for Financial Planning. I work very closely with Jenny. Jennifer Coombs is the lead instructor and co-creator of the Chartered SRI Counselor Designation Program. And today she's going to talk to you about why sustainable investing is more important than ever. So thank you so much for your attendance. And with that, we will get started.
Great, thank you, Lauren. I hope everyone can hear me all right. If not, I'm sure we'll.
You sound great.
Great. I'm sure we'll hear from you shortly if that's the case. And just so you know, you can call me Jenny. That's fine. I do go by Jennifer. If it's in a formal setting like this is. So welcome everyone. Thank you so much for taking the time to join us today. Like Lauren mentioned, I'm an associate professor at the College for Financial Planning. I've been with the college for about 4 years now, and my field of expertise historically has been in stock trading and equity research. But over the years, I've developed an interest in sustainable investing and really have refined it in the past few years with the culmination of the development of the Chartered SRI Counselor Designation Program, which I will talk about later on in the presentation. But letting you know that that is an option to you as we go forward. So today, my hope is to provide you with, and it's my understanding going in that everyone who's listening has some sense of sustainable investing or ESG or SRI already. If that is the case, great. If that's not the case, don't worry too much. I will give us a refresher on certain elements. The idea here too is I only have an hour with you, so I'm trying to provide you with as much useful information as possible. And the idea really here is to, the takeaway for you is to come away with at least some useful topic that'll be prevalent in your practice in some way. The idea here too with most sustainable investments is that when we think about the analysis that goes into sustainable investments, it can feel like we're going through all this big labyrinth of ways to view things. We come across a bunch of dead ends, but ultimately the goal is for us to come out the other end with better investments. The hope is that over time this will become a lot more easier for you as you go through the steps. But certainly here today, if you're coming in with the expectation that I'm going to give you exact mutual funds and ETFs to purchase, that's not the case. I cannot do that for obvious reasons. But what I can do is provide you with some tools that'll hopefully help make that process a little bit easier. And if you're interested in making this more of your practice or the bulk of your practice going forward, definitely consider working with me and going through the CSRIC program to help with that process. So here's today's roadmap for us. I'm just going to give a brief overview of terminology, the way we look at SRI and ESG individually, some global and domestic trends in the space to tee up the fact that it is very much prominent in the financial services industry today, how corporate responsibility plays into that. And then I also want to touch briefly on, in the age of COVID-19, kind of what that is looking like for us in the market perspective. Now, keep in mind that we are not through this pandemic yet, and this is really just examining data that's been brought in from February to what was previously the peak of the pandemic back in June. This is really the information that we have to work with. We might see a different story by the end of 2020. I can't say for sure, I'm not a psychic, but from what we know currently, what is the deal with ESG investing in the age of COVID-19? Performance factors are also something that is very much of concern for investors. And obviously, when choosing to invest in this space, this really is one of the main barriers that investors come up against, is what exactly are we going to do about it? Lastly, a discussion too on greenwashing. This, at the very least, is something that a tool you can take away when looking to evaluate mutual funds and ETFs that have an ESG criteria associated with them. Finally, some common excuses and solutions that you can work through as advisors. I'll give you some details on the CSRIC designation, and then hopefully I can field some questions at the end. But also in the questions slide too, I did provide my email address. So if you do have anything specific, or if for time's sake I don't get around to them, please feel free to contact me. I'm more than happy to talk to anyone interested in this space. So let's kick it off here with a discussion of the differences between SRI and ESG really quick. For many of you, I'm sure you've dealt with this previously, but for some, this might be brand new. So the idea today is that SRI, it's an acronym. For us and our purposes these days, it stands for Sustainable, Responsible, and Impact Investing. So it's a discipline that is really a strategy that is incorporating the criteria of ESG, environmental, social, and corporate governance, into creating a long-term financial plan. Now, you might have historically heard the term socially responsible investing thrown around, and that's not necessarily wrong. The idea, though, with socially responsible investing is that in its original creation, it was done so primarily to eliminate investments that were in direct conflict with societal norms, or more specifically, religious teachings and religious doctrines. More and more these days, though, it's become a little bit more all-inclusive. So not only do we, is there the potential to work with religious investors in that capacity, but we've also made it so that we have other elements that are more inclusive, relating to environmental factors, positive factors that are meant to help advance society. If I like to use the analogy here that it's kind of related to Game of Thrones a little bit, where if you, I'm not going to give away anything from the show, but if you get to the very last episode of the entire series, it really comes down to that important question of who exactly gets to decide what is best for society. And since there was really no overarching rule as to who exactly gets to decide that, it can't be based on religious doctrine. So it does have to incorporate things that are going to be, as we would think, sustainable. They have to withstand the test of time. So all of these terms that are listed around the SRI umbrella here, these all fall under the same category. So even though, one person might call it responsible investing, another person might call it green investing, some might call it impact, they all fall under this same umbrella. So they will all use some degree of the same criteria. Let's contrast that, though, with ESG, and it's, in some cases you see people using the two terms interchangeably. That's not entirely correct. Recall here that ESG, environmental, social, and governance factors, these are the criteria that we use on which to have a certain set of standards that will allow us to screen out investments in a portfolio for an SRI client. So SRI is the strategy, ESG is the criteria to adhere to that strategy. And ESG integration in the United States is currently the most widely used SRI strategy, namely because what it's doing is providing an extra layer of risk analysis on top of analysis that's already being conducted. So just to give you a broad overview, I won't go into super elaborate detail on these, but when it comes to SRI strategies in general, we have 4 broad strategies, but then a fifth that kind of works in tandem with those strategies. So the first one is primarily used in conjunction with the second. So positive best in class is looking at criteria that have positive attributes. So inclusionary processes for a portfolio. I'm including these investments because they are good for the environment, good for social factors, and human rights, etc. On the other hand, the opposite of that would be the negative exclusionary screens. So these are the ones that I'm eliminating from my portfolio based on that environmental, social, and governance criteria. At the same time, too, I can also avoid investments altogether that are deemed to be controversial or contrary to my religious beliefs. This, if you want to think about it, was the baseline for socially responsible investing initially, trying to adhere to that negative screen. And ESG integration is something that I'll go into a little more detail later on because it's the most widely used strategy. It uses ESG criteria as part of the regular investment process. So across valuation metrics, across risk analysis, and since it is not explicitly excluding anything from being analyzed, it's one of the more preferable options for money managers and institutional investors looking to bring sustainable investing to their firms. Sustainability themed investing is one of the lesser used strategies. However, it is getting a bit of a revival with millennial and Gen Z investors, where you have portfolios that are catered to a specific investment theme, namely they're related to sustainability themes. So here, clean technology, green energies, alternative fuels, etc. The fifth option there, corporate engagement, is the process of using shareholder advocacy methods in tandem with the other strategies mentioned. So the idea is that I'm including investments in my portfolio with the intention of helping them to make their practices a bit more sustainable, address issues that might help them become more profitable in the future. And obviously I'm working with the company to help them become more sustainable, not just from an environmental perspective, but also from a corporate earnings perspective too. So let's briefly here talk about some of the domestic and global trends. Now, keep in mind that much of this information collected throughout this presentation is from 2018. There's a reason for that. It does it is collected throughout the entire year and then usually presented at the end of the following year. Also noting here too that the information collected from US SIF, they are the leading organization of research and data analysis when it comes to how major firms are investing. They publish their information on a biannual basis. So their 2020 numbers will be coming out in November or December of this year. So we're still looking at 2018 figures for the moment. So just keep that in mind. As of 2018, you have about a quarter of all the dollars under professional management in the United States using some degree of ESG analysis in some form or way. And that is not just a trend that's been prevalent today, it's actually been climbing quite rapidly in recent years. So on the right-hand side here, you can see this is a chart from US SIF demonstrating an 18-fold increase since they started publishing this data back in 1995. And noting there as well that using shareholder advocacy, it can be a piece of that process too. But ESG incorporation has really started to take off around the 2010 timeframe. Some people like to say that the interest in ESG analysis really peaked when after the 2016 election cycle. Really, it started to taking off after the Great Recession began to end in 2009, and we started to move on. And the idea there really was to begin incorporating investments into your portfolio that are strong and that are going to result in overall sustainability. They're going to withstand the test of time and not collapse due to some corporate mishap. That is also the case in the rest of the world. So the United States is a big chunk of the world market in terms of using sustainable investing practices, but the European Union and the 13 countries that are comprised of the US SIF's reporting data and have been historically responsible for a little more than half. It's not that Europe has shrunk in terms of the size of its market. It's still quite large. It's just that the other economies are starting to get a little bit bigger. So their portion of the pie is starting to get a little bit smaller in this case. But about $30 trillion on a global scale are dedicated to sustainable investing. And these are the major economies that report on this information. Japan actually has had a massive surge in interest between 2016 and 2018, as you can see, making them the third largest economy invested in this space after Europe and the US. Additionally, generational interests have started to peak and really has been doing so within the past 7 years or so. So millennials and also Gen Xers are responsible for, or comprise rather, the bulk of their investment strategies in ESG. Gen Z is not included on this chart, but those that are old enough to start investing have been considered as part of that strategy for analyzing as well. So note here too that it's not purely based on environmental issues or people out to achieve social changes, but rather it's the understanding that in order to make an economy much more sustainable long term, they do have to take into consideration those elements. Leslie, just to reiterate ESG integration again regarding trends here, like I mentioned, it is the most popular trend in the United States for one major reason here. It's that it's not taking anything away from the current research analysis and decision-making process that's located at major institutional investing firms and money managers, but rather it's just adding on to it. It's one other dimension of risk analysis that's been proven to be quite useful. In the end, the result is that if you have two investments that are otherwise identical on paper, one is more likely going to use the ESG criteria as the deciding factor as to whether or not the investment should be considered bought, sold, or held, as the case may be. Now, with ESG integration, like I mentioned, to talk about what it is also a good idea to talk about what it is not. So, like I mentioned, it's part of the broader investment analysis, at least initially, but what it does not do, it doesn't prohibit any investments. So I can still assign ESG analysis to ExxonMobil. I don't have to cut it out of my portfolio if I think in some way it's going to be profitable for us, but it's not going to result in the company being any less sustainable. Doing so in this manner is a good way to help demonstrate to shareholders that it's not going to sacrifice any returns. And the reason it's not sacrificing any returns is because it's not eliminating anything from the get-go. Also noting here too that immaterial ESG issues won't have an impact. So only factors that are going to really be detrimental to the company and to the communities themselves are going to be considered. And the nice thing for many of the firms is that for them, it doesn't require them to change their practice in any way. So they can keep doing the same valuation techniques, model analysis that they were doing. This is just one more additional piece of it. So ESG factors in corporate responsibility is something that's really significant and worth pointing out these days. The idea is that corporations should have a responsibility to protect stakeholders and stockholders alike, but more and more these days it's becoming a good indicator of whether or not a company will withstand the test of time. And I'll follow this discussion a little bit with how COVID relates to that. Really the basis for talking about corporate responsibility is rooted in these two concepts, legitimacy theory, which also feeds into the concept of stakeholder theory. So legitimacy theory was developed in the mid-90s by an American sociologist named Mark Suchman. And this was the definition that he had developed for legitimacy theory. It's the perception that the actions of an entity um, within some kind of socially constructed system of norms, values, and beliefs, that's that they have to do that in order to be deemed legitimate. So, for instance, just on a real basic level, if I were to go to your house and knock on your door, and you invite me into your house, we have, between the two of us, whether you know it or not, created a social contract. The assumption is that I am beholden to the rules of your home. I promise by you letting me into your home, I'm not going to do anything crazy. I'm not going to break things. I'm not going to, you know, go around and insult your family or anything like that. You've given me that valuable permission. It's now a charge of mine to keep, to not screw that up. The same is true with a corporation that moves into a society, that moves into a city. It's up to the company not to screw up that relationship. We have been given permission by society to operate within that system. As soon as we do something wrong, they have the ability to delegitimize our actions, our processes, etc. This feeds into stakeholder theory in a way that is not just talking about an entity. So legitimacy theory could apply to anything, really, me coming into your home, but more specifically to stakeholders. So if I'm looking at it from a capitalistic perspective, and this was developed by an economist named Freeman, not to be confused with Friedman, who is mentioned there as well. Milton Friedman has very much the quintessential view that capitalistic markets have. And that traditional view of capitalism is looking at the process of maximizing profits purely for state shareholders and ignoring the stakeholders, which could not be further from the truth. If you have externalities that are harming society, that is a way that you are going to breach that contract, that figurative contract that we have developed when I move into your society. And what it's proving really is these days, once stakeholders realize their power in this sense, they do have the ability to make a difference. And there's plenty of examples of how this is played out. I'll give you just a couple of companies that ignored really corporate responsibility actions, and then it really came back to bite them. It's done to death as an example, but honestly, it's one of the most damaging, if you will, instances of corporate mishaps that resulted in a massive collapse of the company, its reputation, and also its stock price too, and that's BP. Many know BP for their the Gulf oil spill back in 2010, but they actually had a series of accidents that led up to that incident happening that ultimately resulted in them being excluded from many major sustainable investing indexes prior to that Deepwater Horizon incident in 2010. There were a series of smaller accidents that the company just failed to address repeatedly over and over again. As you can see, these are incidences occurring within the society. Society was, starting to delegitimize them in the beginning. But then there were major ESG research firms that noted this well before this incident happened. And, it's just a series of red flags popping up that one needs to be aware of. And if you want to think about ESG analysis in that way, that's a pretty good analogy. It's looking for the red flags before you end up with a situation like this. And there's been argumentation as to how much exactly it ended up costing BP's share price, or rather not its share price, but rather its overall corporate profitability. The total costs ended up being approximately $62 billion. But even 10 years later, there are still residual costs that the company is still undertaking. And the idea here was, even though this is a little bit dated in terms of performance, to show you that it has since 2010 underperformed its peer group and continues to underperform its peer group. Equifax is also a massive example that's happened in recent years, and also one not related to environmental factors. So you had ESG analyst firm MSCI take a look at Equifax back in mid 2016, where they started to point out that the company had absolutely no contingency plan or training or really anything in terms of educating their employees on what to do if a data breach were to occur. And going through these channel checks and finding out that that's what the company didn't have, they removed the company from their Sustainable Investment Index on November 30th, 2016. And fast forward a year later is when Equifax, after waiting a few months, finally announced to the public that their information had been compromised. And this was data that was provided this chart rather, was from a piece in the Wall Street Journal that was talking about how sustainable investing was one of the earmarks of pointing out Equifax's flaws well in advance. Now, I could say that since this time, Equifax has rebounded, and that's kind of the point as well, that you just don't want companies to fall and stay down. But if they come up with a way that is going to be beneficial, that will boost their reputation, if they confront the controversy head on, they demonstrate to society that they are serious about changing, then they will rebound. That is sustainability in its essence. It's really pointing out the flaws and then moving on from those. And so I can say from here that Equifax has rebounded. However, if you were relying on Equifax as part of your portfolio in retirement years and this occurred, you'd be pretty annoyed. So the idea here really, though, is that there is hope for some of these firms. And leading into that now is talking about how we can look at ESG or think about it in the age of COVID. And not only addressing controversies that have come up for the companies, but also what they plan to do about it. Even if it wasn't really impacting their industry all that much, they have the ability to fix it. So companies really that I've discovered, and what the overall consensus is for those that look at ESG data over the last few months due to this pandemic, is that any stresses related to COVID have been demonstrated at some firms to be all right if they have a contingency plan in place, or if they were noting that an event like this could occur. Those ones will eventually have better financial performance and higher valuations. Also, those that are recognizing areas that are struggling and will lay out a plan to fix those challenges. This is why you see many of the stock prices of these companies rising, because there is optimism. They recognize what needs to be changed, and they outline for the public how they plan to do so. Another factor worth noting there too is that it's not always environmentally related. Many of the ESG reports that I had seen was that, the ESG analysis is primarily just fixated on the fact that there's less cars on the road, there's less airplanes, there's less offices consuming, and that is something that just makes ESG more attractive. Well, it can, but also when we're talking about sustainability, we also mean sustainability of the firms themselves. So the ones that have demonstrated that they are able to make creative workarounds, handle stresses, even though corporate earnings are going to be down for many companies for the next few quarters, the plans that they outline are the things that the market are going to be caring about. Bloomberg also noted here too, when it comes to performance, that the average ESG fund has been handling quite well. It has not lost as much as the S&P 500 related investments have over the same period for COVID. Again, relating to the risk factor. If I'm conducting ESG analysis, I'm primarily doing so to limit the degree of risk in my portfolio. And also you can see here too that the pandemic will also trigger a surge in SRI. The anticipation is the interest, it's already high, but it's expected to be higher after this incident because they'll want to understand what the secret sauce is to making these types of investments so durable. And when you're talking about ESG analysis, it's important to remember that the performance factors are really just looking at material information. The material factor when it comes to ESG is really anything that the company ought to be reporting. And even if it is related to something like environmental issues, it has to be shown, it has to be demonstrated. And that is going to ultimately help boost their overall confidence from shareholders, but also help to cement their place in the market, that it's going to be all right. And I love this quote from SASB director there, Katie Schmitz-Ullett, that ESG is not a passing fad, as we know. It's a bull market luxury and a bear market necessity. And when we're in a bear market, we have to consider these factors. We have to consider that risk dimension. Now, like I mentioned, we're still in the peak of the pandemic. This is merely what organizations like Bloomberg and SASB and Reuters are starting to talk about in relation to how ESG is going to drive the demand going forward, but just something that we need to consider these days. So understand that this area is still very much evolving. Addressing divestment concerns is part of the talking about the performance issues. When we think about ESG portfolios, one of the main arguments that's been coming out of places like the Department of Labor recently is that it's just harming performance. That myth actually comes from the exclusion of what are known as sin stocks. So anything that's looking to perpetuate a personal vice that offers no intrinsic benefit for society. Originally, the main legacy SRI funds were eliminating those types of investments, in particular tobacco stocks. And tobacco stocks are notorious for paying very high dividends. So eliminating those would obviously harm what they deem to be dividends that an investor could obviously return. But again, talking about the stakeholder theory element there, we're eliminating those from the portfolio, but for a reason. There are so many externalities that are harming society in general. One of the organizations that was picked on by this recently was CalPERS, the employee pension fund for the state of California, which is one of the largest corporate or public pensions in the world. They claimed that over a 17-year period that the pension fund lost $3.5 billion in returns simply because they eliminated tobacco stocks from the portfolio in general. Well, keep in mind that on an annual basis in the state of California alone, they spend about $9 billion on tobacco-related illnesses. $8.5 billion is lost on an annual basis due to things like smoke breaks, illnesses, all related to tobacco issues. But that's just on an annual basis. So it kind of puts in perspective what and exactly how much of a price tag you're putting on that 3.5 billion that was lost from excluding tobacco from the portfolio. So the STIN stock exclusion really is how we get to the crux of performance issues. Now, if you have the opportunity to read the white paper from Jeremy Grantham, one of the co-founders of GMO, wrote a piece in August of 2018 called The Race of Our Lives. And what he does in there is evaluate different dimensions of factors that are affecting us sustainably, not just from an energy point of view, but also from consumption for human populations. What he attempted to do in that was to face this divestment myth from fossil fuels, noting that the energy sector does not return that much to the overall S&P 500, the annual basically return. What he did was take the S&P 500, as you can see in the pink there, and for each of the major sectors of the S&P 500, there are 9 major sectors, he eliminated one of the sectors each time. So for example, on the top line there, X, the healthcare sector, it's all the sectors of the S&P 500, but now excluding healthcare. Then second one, all the sectors of the S&P 500 excluding consumer staples, and so on and so forth. What he found was, for on this top line here, between 1989 and 2017, the difference in return from the top performing portfolio to the bottom performing portfolio, which you can see on there, is 50 basis points. And you see the energy sector is right smack in the middle of that period. Now, one could say that if that's all the return that I'm sacrificing over that time frame, there was a lot that was happening during that time frame, so it could be related to that. So he went back even further to 1957 and to 1925, even pre the Great Depression. And both times there you can see as well, the top performing and bottom performing differences were 61 basis points and 54 basis points. So less than 1% of the return would be sacrificed if you ended up excluding any one of these indexes. If you completely eliminated the energy sector, which was wrought with fossil fuels back in the 50s, back in 1925, then you would end up with a lot of concern. So that is just really to illustrate that you can effectively put a price tag on the energy sector. Another thing worth highlighting is that solar and wind energy is not that expensive anymore. Xcel Energy, actually here in Colorado, had tried to close some of their coal-fired power plants down and replace them with wind and solar energy, and solicited bids from the market. And they only expected to get a few bids, but they ended up getting over 800. And noted here too that with the cost savings from wind and solar were remarkable for them as an energy company. The 2 dotted lines that you see here, the top line there is if you were today open to start from scratch a coal-fired power plant, the build cost and the operating costs would result in that much of energy use prices, megawatts per hour. However, to build and also run a solar farm or a wind farm would be even less than just the operating costs alone for a new coal-fired power plant. If the idea is cost savings, that's obviously a better case. And certainly this was not the case about 10 years ago when I first started looking at energy prices, and noted back even in 2009 that it was just so expensive, solar and wind energy. But in recent years, the price has come way down, and it continues to go down. And if you'll notice that coal is that little green diamond there, to point out that it's stayed relatively the same, for decades, actually. The price of coal has not changed that drastically, especially not in recent years. Sorry to skip ahead there a little bit, but noting here too that investors are realizing that as well. It's not just those fixated on environmental factors, but also investments in general. Even ETFs that have focus on clean energy are massively outperforming ETFs that look at all energy, even those that include fossil fuels. And these are some charts from Bloomberg in recent years that have showed that divergence in the 2 areas of interest. Some more performance factors also worth noting here too, that the issuance of new ETFs and mutual funds are also helping to drive down the costs of owning sustainable investments. So this data from Morningstar notes how many new issues for ETFs and mutual funds that have come out just in the past few years alone. And it's not as though the demand didn't exist prior to 2015. They were being issued, but they just were not as robust as they were in recent years. So the greater interest in this space is also helping to drive down the cost. Other elements worth noting too regarding performance, there is no single motivation or approach. So obviously there's no way for the industry to really standardize it. For many that have issues with SRI performance factors, they're using the wrong benchmark to note the performance. That if I'm using the S&P 500, which is usually a much more diversified index, that's not excluding investments, it's not going to be conducive to demonstrate proper performance. So you need to have it compared to an index that is much more similar to that. Usually that's the MSCI KLD 400 social index, which we'll look at momentarily. Also worth noting here too that the growth in ETFs and mutual funds is helping to lower those expense ratios, and also that companies within the S&P 500 are starting to recognize that using ESG disclosures, even though the SEC has yet to demand that they do so, have taken it upon themselves really to appease shareholders and do so. So noting here too that even back in 2011, there were only 20% of the 500 companies in the S&P 500 were having some kind of sustainability reporting in some way, no matter how small. And you see the progression up until 2018 that almost 90% of the companies in the S&P 500 give you some kind of sustainability report. Now, this is without SEC guidance, and the expectation is that over time, it will become mandatory that they do so. However, today it's really just the demand that the shareholders are looking for to drive that. And also worth noting here too that even if you're using the benchmark here, difference-wise, the MSCI social index has 400 listings, less than the S&P 500, but there's a reason for that. It's of a high-ish quality. It was actually issued under a different name in the early 90s, but it's been tracking 400 sustainable investments, which they rebalance constantly in order to keep up with the changes that occur at those firms. Most notably, say, Equifax, for instance. So the idea, though, is that it mirrors the performance of the S&P 500, but it outperforms just slightly more. Not to say that if you're looking for some major divergence, that's not the goal. It's really just to demonstrate that the performance is just slightly better because you are looking at higher quality investments. Now, the concept of greenwashing came about because we have such an elaborate demand in ESG these days, but really no guidelines as to what constitutes sustainable investment. What you do have instead are those investors who are really dedicated to this space and want to ensure that if they are going to be investing in a green or an ESG certified, if you will, mutual fund, that they are in fact being an environmentally friendly mutual fund. But greenwashing is really the practice of really using this space as a marketing tool rather than making a difference. So there are some suggestions these days how to properly evaluate a sustainable mutual fund ETF. Feel free to email me after this. I will give my email address out if you want the elaborate details here, but just on an overarching view, the 5 major steps that we would do to evaluate mutual funds and ETFs is look at their prospectuses, not just the marketing material itself. Look at how the fund is identifying as being sustainable. If it's just in the title of the investment and nothing is mentioned in the prospectus, that's a big red flag right there. If they don't describe in the prospectus exactly what they're looking for criteria-wise to incorporate sustainable investing factors, that's another issue. They could even say that they're basing it off of research from MSCI or Morningstar, but they have to note that that is who they're following. The fund can also offer an impact report. The impact element is usually linked to something like the United Nations Sustainable Development Goals, to demonstrate to investors that their money is making a difference. Usually that is the goal when creating an ESG mutual fund. If they don't have that, might be a little bit skeptical as to what their motivation truly is here. Usually the fund managers will provide some kind of information when even a regular prospectus as to the valuation metrics that they look to include an investment, or some that happen to cause them to exclude an investment. So they should outline in there exactly what positive or negative criteria they are examining. And then finally, and this one's probably the most fun, if you will, you can also do this with on Morningstar or even Yahoo Finance. Look up a sustainable mutual fund and just take a look at the top 10 holdings of that mutual fund and see if they make any sense. If they have ExxonMobil as one of their top 10 holdings, they ought to, in their prospectus, describe why it's one of the top holdings. If they don't do that and they're calling this a sustainable portfolio, you can tell that they just don't know what it means to create a sustainable portfolio. So these practices are obviously being refined in recent years, but just something to be cognizant of in your evaluation of mutual funds and ETFs. Now, to address some common excuses and solutions to those excuses that have come up in recent years, it obviously goes beyond these, but some of the more common reasons that I've heard, at least from advisors, are things like, I don't know which SRI products to recommend. Many come to these webinars thinking that they'll get a big list of products to recommend. The idea really, it's just practice. It's reading and understanding these. When ETFs were first issued to the market, I guarantee you nobody knew what the heck they were talking about. What do you mean there's an equity-like device that mirrors an index performance? That's witchcraft. How can that be? But obviously over time we learned about them and we understand them now. So that same goes with understanding these products, how they're constructed, how they're evaluated. Also, some say, I just don't want to give up my current financial practice to accommodate SRI clients. If you're giving anything up, you're doing it wrong. ESG should only add to your practice. It should never take anything away from that. The other element there too is that you don't want to sacrifice returns to save the planet, again, thinking that you're taking something away from the practice. As you've seen, and hopefully these slides at the very least have demonstrated, that when you incorporate this as part of the broader risk analysis, it does result in better quality investments. It's really a quality function here, and quality ultimately leads to long-term sustainability. And lastly there, if you don't know how to talk to your investors about SRI, or if I just flew through all this material and you feel like you're drinking from a fire hose, number one, I apologize. But number two, that can be fixed. There are ways that we have to better help individuals understand these products and understand these better. And that's obviously a big one, is through the Chartered SRI Counselor designation that we offer through the College for Financial Planning. Just a little bit about it. I am the original developer and author of this program. I did so in partnership with US SIF. They're the Forum for Sustainable and Responsible Investment that were founded in Washington, D.C. back in 1984. They are the leading provider of data in this space, so I'm very happy to be working with them, and they are likewise happy to be working with us. We have a really great relationship and are happy to bring this to the market. Previously, there were only certificate programs available in the sustainable investment space. There is a certificate program through the CFA Institute of the UK. There's also a certificate program available in Canada. In Australia, there's also it's almost like an audit, if you will, of your financial practice that they conduct. But none of these actually result from in an education program that leads to a designation that you can then tack onto your name as a title. This is the first one really in the world, but namely in the United States, that is dedicated specifically to SRI practices and ESG analysis. And just to give you a little bit of an overview, if there's things that are missing in this course today, obviously no. We do have an entire module that talks about ESG scores and ratings and how that can be used in analysis, proper asset allocation in this space, the importance of disclosures for components of the S&P 500, and actually why the SEC ought to become more involved with this. The history, a timeline of events. We go into much more elaborate detail on the strategies that were talked about previously. So content-wise, this is really the drinking from the fire hose now, but I'm trying to make it a little bit more digestible. A little bit about the program itself. It lasts, it can be completed in about 2 to 3 months. There are 7 modules in total. We go through live classes that usually happen over the course of 8 weeks with 2 classes per week, so 16 total. The idea here too is to give students a little bit more of a networking opportunity in this space. That is something that we're working with US SIF on, to provide more networking opportunities to the students with this designation. Once you go through the program, the idea is to pass a final exam, receive a 70% or better score on that exam in order to be able to use the title. Currently, there are about 250 or so students that have gone through this program. Now, keep in mind that this program has been around less than a year and a half, so that is quite typical. Actually, it's quite better, especially for a brand new designation. There are about 190 or so individuals who have the designation already across the United States and are enjoying the benefits from that. So it's also great that this was developed in partnership with US SIF, because going forward too, we do have the ability to share as well the updated information relating to the program. So if you have an interest in this or anything else, I'm happy to entertain some questions. Lauren did have to drop off, but I wanted to just double check and see the questions that we have here now. So Sandy had asked if you can download a copy of the slides. Just send me an email to this address here noted on the screen, and I'm happy to give everybody a copy of the slides. For the attendees, actually, I think you do get a recorded version of this course, so I can send that along as well. The next slide actually has a list of all the references. If you saw the little subscript or superscript of the numbers throughout, they're referencing that page. So you can look up at the original sources for these. Oh, thank you, Sen. I appreciate that. That's an excellent presentation. I certainly hope so. Yes, I can get everybody copies of the things that they need. Oh, and how are the exams being held in the COVID world? That's a question from Deborah. That is a great one. So what we have done is allowed students to test remotely for the time being. So our designation testing and even CFP these days can be done from home. There are certain rule requirements that they have to look into, you know, proctors and such. If you know, you want to check on those. But the short answer is that the exams are still being conducted. You can just do them remotely instead. You don't have to go to a testing center, but they do have some checks in place to make sure that people are being fair. Best ESG webinar I've attended so far. Thank you so much. I really appreciate that. Yes, that's great. And for everyone who's here, I I really appreciate you stopping in today. If you'd like to discuss further, you don't need to be a student of mine to reach out and talk about this. I'm happy to entertain questions from anybody, anywhere, anytime. Uh, this is a great and developing space, and playing off information and learning new things is I always try to keep an open mind in this, and my hope is that you do as well. So keep learning those and keep up to speed in the space, and hopefully that'll be a great way to refine it, certainly. Any other questions from you guys? I really appreciate it. Let's see. Yeah, benchmarking is quite difficult, I know. And it's still being refined to an extent as well. Besides the designation course, did you recommend we consult to learn more? So USSIF's website, it's just ussif.org, is a plethora of information, Catherine, that has white papers that are constantly being published, specific information relating to different investments. So you can look at a ranking of mutual funds, of ETFs, what they deem to be important. They're an amazing resource, and even from them as a resource, you can find sub resources there too. It's a good reason. It's a main reason really why I wanted to partner with them on this designation, was that they are a plethora of information. So definitely check them out for more. Thank you very much. Very interested in the online course. The classes are online, Marilyn. Yes, they are. And for the most part, at least now, I'm the one teaching them live. But I did create the video material related to those too. So that's all web-based. And you're welcome to attend those. Oh, great. I'm glad that we were able to help with the anomalies that were not understood. And yes, you can all get a copy of the deck. I'll make sure to provide that to everybody. The address for the source, yes, it's ussif.org is the address. And you can find information on the mutual funds there. You just have to click around a little bit. So Marilyn, there's no prerequisites for the course. In terms of designations, if you have to be a CFP or financial advisor, nope. I've had equity analysts, I've had insurance agents go through the program, so no prerequisites for there. There are discounts available, Catherine, and I'm sorry that Lauren had to drop off because she knows exactly what those discounts are. Send me an email and I can find out what they would be for you. It depends on the organization that you work for too, but I think also FPA members can get a discount as well. Discuss the class topic. So there's 7 modules total. Each class is about an hour long, and I dedicate 2 classes per module. So there's 2 hours total talk about in each module. There's a review session, and then I also have a session where we talk about how to evolve the space. It's a very interactive course, and I like to get to know my students in here a little bit better, and then we share information kind of in the last class. So we're a fun group. I'm always looking forward to new students coming through. So I hope that helps. Great, thank you so much. Is there a mutual fund or an ETF that mirrors the MSCI index? I believe there is, Susan. Again, check out USSIF's site for the exact information there, but there's and certainly other indices, some even not based in the United States, that follow sustainable investments too. But again, this is one way that we can help make it a little bit better. Thank you, Anita. Appreciate it. All right, it looks like I'm up against the hour, so feel free to reach out to me, everybody. Let me know if you have any or questions beyond this. Please do let me know if there's anything I can do to help as well. And thank you all very much. I hope you have a wonderful rest of your week. Take care, everyone. Thank you.